Let me ask you, what do you think the bank is doing with the money that you have in your checking account and your savings account? Welcome to the first concept, which is the spread. This is super easy to understand. How does banks make money? They take those balances and they pay you how much? 0% in some checkings account. They even charge you fees, and they get that money, or sometimes 1% in savings, and they take that money and lend it on mortgages, making 4 to 5%. So the spread is basically the 4 or 5% less the 1%. Let's call it 4%. And if you have, for example, in this example, $48,000 between husband and wife, between checking and savings, the bank is making money out of that money. So the first thing that we're going to do is we're going to take that money and we're going to pay it off in in full, or deposit to your principal, so you don't have to pay any interest on that, plus you gain the interest that you were going to pay on that money. That is basically reducing your cost of credit, in this example anywhere between $2,000 to $4,000 per year, and that's money that gets back to you automatically because you're taking away the spread. Now, in this example, we said checking account between husband and wife 12,500. Saving, they had 35,800 between husband and wife. So the total cash was about 48,000, and we just deposit that into the mortgage, so your balance was reduced right away. Now you're gonna say, Camilo, but I need that money as an emergency fund. I don't want to be cash poor. What happens if something happens to me? And that's the main reason why people don't apply this to the principal. So we're, at the same time that we're gonna do this, we're going to give you a line of credit for the same amount or more. In this example, for example, this is a regular statement, mortgage statement with Manulife, which is one of the banks that we work with. You will see down below here $85,000. This $85,000 is the line of credit available that you have, which you pay zero payments because the balance is at zero. The interest rate is prime plus a half, and it's just sitting there just in case you have an emergency, while your savings are working for you and not the bank. Let's move to the next concept.